The $49 mistake that nearly broke the company. What if I told you that a single number nearly destroyed a company and then saved it? Not a product redesign, not a viral campaign, not new investors, just a price. Because pricing isn't just math. It's psychology, it's positioning, it's power. And in this story, one strategic pricing decision didn't just increase profit. It reshaped how customers saw the entire business. 3 years ago, a small consulting startup launched with a simple mission: help small businesses streamline their operations using smart digital systems. The founder, Daniel, wasn't flashy. He believed in value, hard work, and being fair. That word mattered to him. Fair pricing, fair margins, fair deals. He priced his core service at $49 per month, convinced that affordability would attract volume. And at first, it did. Sign-ups trickled in, then flowed. Within 6 months, they had hundreds of customers. Online reviews praised the service as incredible value for the price. Daniel felt proud. He believed he had cracked the formula. Low price, high value, steady growth. But then something strange happened. Revenue kept increasing, yet cash flow felt tight. The support inbox grew faster than the team could handle. Customers constantly requested extra features. Many delayed payments. Some canceled after 1 month. The churn rate hovered at uncomfortable levels. The team worked long hours, but profit margins remained thin. Daniel reassured everyone, saying, "We just need more customers." So they pushed harder on marketing. More ads, more promotions, more discounts. Growth accelerated. Stress multiplied. Here's the hidden truth about low pricing. It doesn't just attract customers. It attracts a specific type of customer. And not all customers are equal. The $49 price positioned the service as a utility, not a strategic asset. Clients treated it like software they could replace tomorrow. They negotiated aggressively. They consumed support time excessively. They demanded custom solutions beyond the package. The team began feeling underpaid and undervalued. Internally, morale dipped. Externally, the brand looked affordable, but not essential. Daniel started noticing a pattern during sales calls. When prospects asked about the price and heard $49, the reaction wasn't excitement. It was hesitation. Some even asked, "Why is it so cheap?" That question haunted him. Cheap can signal accessibility, but it can also signal compromise. One evening, reviewing financial reports alone in the office, Daniel ran the numbers differently. What if they doubled the price? What if they tripled it? The idea felt dangerous. What if everyone left? What if revenue collapsed overnight? The fear wasn't about math. It was about identity. Raising prices felt like betraying the company's original promise to be affordable. But staying the same felt worse. Over the next month, Daniel did something most founders avoid. He spoke directly to their most successful clients, the ones who stayed longer, the ones who implemented the systems fully, the ones who got real results. He asked them a simple question: what would this service be worth to you if it doubled your operational efficiency? The answers shocked him. Several clients said they would happily pay 5 times more if the service continued delivering measurable impact. That was the turning point. Daniel realized they had been pricing based on cost, not value. They calculated hours worked, server expenses, payroll. But customers don't buy costs. They buy outcomes. They buy transformation. And transformation has a very different price ceiling. After weeks of internal debate, he made the decision. They restructured everything. The $49 plan would be discontinued. In its place, 3 tiers would emerge: $149, $349, and a premium custom package starting at $1,200 per month. Alongside the new pricing came clearer positioning. The messaging shifted from affordable digital tools to strategic operational transformation. The website language changed. The onboarding process improved. Support was streamlined. The entire brand elevated. The day they announced the change, anxiety filled the office. Some customers reacted exactly as feared. Cancellations came in. Social media comments questioned the increase. A few called it greedy. Revenue dipped temporarily. Daniel barely slept that week. But then something unexpected happened. New inquiries started coming in, different inquiries. Larger companies. More serious decision makers. Conversations shifted from, "Can you lower the price?" to, "How fast can we implement?" The tone changed. Customers asked deeper questions. They respected boundaries. They valued expertise. Support tickets decreased because clients invested more effort into using the system properly. Within 3 months, revenue surpassed previous levels. Within 6 months, profit margins doubled. The company served fewer clients, but better clients. The team worked fewer hours, but created more impact. Internally, morale improved because the company finally felt aligned with the value it delivered. The most fascinating shift wasn't financial. It was psychological. When the price increased, perceived value increased with it. Prospects assumed the service was more advanced. Customers committed more seriously because they had more at stake. Higher pricing filtered out misaligned clients and attracted those who saw the service as an investment, not an expense. This is where many entrepreneurs misunderstand pricing. They believe lowering prices reduces friction. Sometimes it does, but it can also reduce perceived importance. People protect what they invest in. They question what feels too easy. Daniel later admitted that the real mistake wasn't underpricing. It was underpositioning. The low price told a story the company didn't intend to tell. It whispered, "We're just another tool." The new pricing declared, "We are a strategic partner," and the market responded accordingly. Let's step back from the story for a moment. Pricing is not just a revenue lever. It's a branding decision. It defines who you attract. It influences how seriously customers take you. It shapes internal culture. If your price is too low, you may win volume but lose authority. If it's aligned with value, you win respect. Of course, this doesn't mean raising prices blindly. It requires confidence in your outcome. It demands clarity in positioning. It forces you to elevate delivery standards. But when done strategically, pricing becomes a filter and a magnet at the same time. Daniel's company eventually stabilized at about half the customer count it once had, but nearly triple the profit. They reinvested into product development, improved training, and built a reputation as a premium solution in their niche. Competitors who continued racing to the bottom struggled with constant churn and thin margins. Meanwhile, Daniel learned that sustainable growth doesn't come from being the cheapest option. It comes from being the clearest and most valuable option. There's an uncomfortable lesson here for many businesses. Sometimes the revenue ceiling isn't caused by market limitations. It's caused by self-imposed pricing beliefs. If you don't believe your solution creates significant value, you'll price timidly. And the market will mirror that hesitation. The pricing decision that changed everything wasn't about greed. It was about alignment. Alignment between value delivered and price charged. Alignment between brand identity and market perception. Alignment between customer expectations and company capability. And perhaps the most powerful insight of all, the market often respects what you respect. If you undervalue your work, others will too. If you confidently price based on transformation, not effort, customers who seek transformation will step forward. So if you're building something today, whether it's a product, a service, or even your personal expertise, ask yourself, are you pricing based on fear or based on value? Are you trying to be affordable to everyone or indispensable to the right ones? One number can change everything, not because it magically increases revenue, but because it forces clarity. Clarity in positioning, clarity in target audience, clarity in confidence, and clarity is profitable. If this story made you rethink how you value what you build, then you're already ahead of most entrepreneurs. Success isn't just about selling more. It's about selling smarter. If you found value in this episode of Wealth Narrative, take a moment to like the video and subscribe to the channel. We explore the financial decisions, strategic shifts, and leadership moments that quietly define success. And the next story might change the way you see your own business.